Good evening. This is Ken Long from Tortoise Capital Management. I want to go through a 60R trade with you in Cleveland Natural Resources and how it all unfolded. Now, the market health check on 4 May 2010 showed the market in bull normal conditions. The trendiness on the ADX you can see declining, and there has been an increasing bearish tendency, as you can see in the minus DI line here. The market's had an extraordinary run up for well over a month, but in the last 10 days you can see the market starting to fragment. On Williams percent R10, you can see how it's been overbought for most of that period of time. Started seeing some weakness here, and then a sell-off, a couple sharp sell-offs, failure to get back into overbought conditions. And so even though the market is well overbought on an annual basis with Williams percent R260 at high levels, you can see that there has been weakness developing. On the day before, on 4 May, you can see that the market has breached the key support level of 118 and actually came down and touched the 50-day moving average. So there's reason to believe that there has been problems in the market. When we took a look at the daily summary that day, what we saw was that all of the overreaction systems, with the exception of EFA, the Euro-Asian mix, fired on the overreaction system and fired on the channeling system. You can see, though we're bull normal, we are oversold on a 10-day basis. Again, you can see the weakness in the Williams percent R. And you'll note that Alcoa, symbol AA, was one of the max pain candidates in the Dow 30. The percent stretch with respect to the 200-day moving average, although bullish, is in the red zone, meaning that it's definitely weakening the trend. SPY volatility had gone through almost 2 months of very low volatility, but now has crossed back up and is right on the edge of going into volatile. None of the pattern signals fired, and so Alcoa became a very important piece of the mosaic here. So what we have is a market that's been extremely strong, but the overreaction system and channeling system both fired, indicating that there's a possibility for a sharp rebound in the next few days, in the next 3 to 5 days. And Alcoa, the basic materials, have been weak, and then when they reverse, what we see is that candidates in the 10-day max pain have rebounded very nicely. On the daily tactical, you can see that yesterday, or actually on 4 May, Alcoa, highlighted in red, was one of the large percent losers that day, along with Caterpillar and DuPont. So we have, once again, this theme of materials having been really crushed that previous day. The only ones that were winning were the defensive sector stocks like Walmart, Merck, and Pfizer. So once again, Alcoa, well oversold. It had lost 4 1/3%. It was low on the 10-day index, and was max pain on 3-day and 10-day. On the daily zoom in of additional indicators, again you can see the price pattern in SPY. This is the 30-day regression line, and you can see how it's now fragmenting out here, and R squared, which had been up above 0.9, is now breaking down to 0.4. 2 days later we'll see that it's at 0.02, but you can see how this positive quiet trend has now started to fragment. And again, you can see the percent stretch, which had got up near the 6-month normal, has been failing. And the slope of this blue regression line here, you can see how it had made a 1, 2, 3, 4, 4.5 standard deviation move in this long bull run of the previous month. But now, starting right about here, with this first big red candle, it started to fail And then this weakness here is what's causing the slope of that regression line to start to fade. Among the sectors, what we can see is that the relative strengths compared to SPY, the red line is U.S. mid caps, and the blue line is U.S. Small caps, and both of those are above the zero line, which represents the market. So we've taken the market out of this. So both of those sectors in the U.S. are dominating all of the other international indices. You can see gold is actually starting to outperform. And now, key to note that for some time now, this dark green line is EFA. That's the Euro Asian ETF. And you can see how weak that has been and getting weaker. And that's going to be an important theme for us in 2 days. Okay, now moving on to Cleveland Cliffs. Now, what happened on the next morning was that we had a significant gap down, and this is not unusual when you have market conditions like you see here. The overreaction system fired on this big red candle. It closed weakly. It was a big day down, so everything was looking bad. The next morning there was a significant gap down, and then Cleveland Cliffs immediately started to rebound. Now, since we knew that when we saw the market starting to improve after this gap down, and so that's a morning hook, and now we're starting to look for things that are outperforming SPY on this recovery. And all of the natural resources areas like Alcoa and Caterpillar and XLB, the ETF for materials, started to outperform, and Cleveland Cliffs was gaining the most. So let's take a look at what happened with Cleveland Cliffs. So it closed here on the 3rd of May. You can see the big red candle down, an immediate reversal. About 20 minutes into the trading day, we had this little red doji, and then more strength. And so the entry on trade 1 was at 54.3 with an initial stop of 25 cents. Low risk trade. The market is moving up at this time. 30 minutes later, it's starting to climb. It's gone all the way up to 55.10, where we make our second entry, again with a 0.25 I stop, initial stop. We get to no lose on both of those positions quickly. The third entry, we can take at 56.25 with a 25-cent initial trailing stop. Our fourth entry, after this little burst and recovery, that little green doji was very successful. I was getting ready to cash this one, but we got some strength. It takes out, now we have this lazy W formation here. I make my fourth entry at 57.10 with an initial stop at 25. And then Cleveland Cliffs just continues to climb to glory. Look at this, all the way up to almost 60. On this pullback here, it was just too much. It was too good. And so made the exit at 59.40 with all except a core position that I was willing to hold overnight. So about a $2 initial stop, and I'm risking $250, so that's about 1,000 shares. Now, each one of these positions were one bullet, meaning that I'm risking $250 per trade, and with a 25-cent trailing stop, each of these entries is for 1,000 shares in Cleveland Cliffs. So by the time we get to the fourth position, we've built a 4,000 share position. All along the way, however, we've been adjusting our stops and getting to no lose quickly, and then letting the trade go as far as it wants to go. And so at the end of this thing, what I found deceptive was the scale of this was so wide that I didn't even realize how good that position actually was. And so we ended up with, on the first trade, entering here and exiting at 59.40, a 20R win, 17R, then 16 and some change, and a 9R win. So when this thing nets out to about 60R over the course of the day. So not a bad day at work at all. So that's the ready, fire, aim technique based off of market mosaic, and using the market condition and the overreaction channeling systems and the max pain to steer us towards materials, and then Cleveland Cliffs in the morning, followed by market strength, and then Cleveland Cliffs outperforming got us into that trade, and then from there on it was just trade management. So thanks for your attention.